Hello and welcome back to this week's market update. Today is Monday, October 14th, 2024, and we had a lot of inflationary data and economic data last week to cover, so we will hop right in. Stocks rallied last week on optimism surrounding a potential soft landing for the economy, as well as a strong start to the Q3 earnings season, with the S&P 500 closing above 5,800 for the first time on Friday. As of Friday, October 11th, the Dow Jones Industrial Average led the market up 1.2%, with the Nasdaq and S&P not far behind, up about 1.1% last week, and then the Barclays Aggregate Bond Index down almost 0.5% as interest rates rose. Jumping into last week's economic news, we got the September CPI with headline inflation coming in slightly higher than expected, but still showing improvement. Headline CPI at 2.4% annually, 0.2% monthly, and then core CPI at 3.3% annually and 0.3% monthly. So you can see we've made significant progress continuing to go down further and further in that headline inflation number, while core CPI has been a little bit more sticky in the last few months. But overall, making a lot of progress towards the Fed's 2% goal as they tried to manufacture a soft landing. Breaking it down by category, we saw a lot of categories show disinflation or actually deflation on a year-over-year basis. You can see food as a whole up 2.3%, with groceries only up 1.3%. So a lot of improvement in inflation at the grocery store. One of the biggest drivers of this month's lower CPI print, energy is down almost 7% from a year ago, with gasoline down more than 15% from September of 2023. Other categories like new and used vehicles are actually down from a year ago, so good time to be a car shopper. Other things like shelter, that has also seen a disinflation in the inflation rate, as before September, the inflation rate was above 5%, so that's good news there, although 4.9% inflation is still quite sticky. And last but not least, transportation services still up 8.5% as auto insurance and repairs continue to be quite expensive and inflationary for consumers. So overall, this month's CPI print was a positive one, with some sticky categories holding the inflationary indexes up. Along with last month's CPI, we also got the PPI print, the Producer Price Index for September, showing headline inflation a little bit lower than expected at 1.8%, and core inflation, which excludes food, energy, and trade, at 3.2%. On a monthly basis, it was actually flat month over month on a headline number there, while core PPI was up just 0.1%. And then when we look at the breakdown of goods versus services, whereas what is really driving this inflation for producers, it ultimately comes down to services. You can see with the goods category actually down 0.2% in the month, while services are up 0.2% in the month, ultimately leading the PPI to be flat on a month-over-month basis. So services continue to be a sticky part. You can see transportation and warehousing continues to be sticky, but hopefully as gas prices have fallen quite a bit from a year ago, that feeds into lower producer prices in that category at least. Moving along through our week, we also got the Consumer Sentiment Index from the University of Michigan. It showed a 1.7% decline in overall sentiment in October. However, this is still up 8% from a year ago and up almost 40% from the 2022 lows in consumer sentiment. Consumers continue to report frustrations with higher prices as well as a lot of election uncertainty. So it'll be very interesting to see whether this goes up or down following the election. Typically, this index comes out the first half of the month, so it definitely will be moving quite a bit in November, depending on who takes the election. So very interesting stuff here. Seems like sentiment is improving, although it does not come without its choppy month-to-month data points. Earnings season kicked off last week with major banks like JP Morgan and Wells Fargo reporting better than expected results and leading the S&P 500 higher on Friday. With that, we also want to take a look at what are the expectations for the rest of the sectors in the S&P 500. So, financials have been revised up a little bit in the last few weeks. You can see from September 30th to October 11th here in this chart. They were originally thought to be negative year over year. Now they are expected to be slightly positive. So I'm sure that will change as more banks and financial companies report earnings. But within the sectors, information technology, communication services, healthcare, and real estate are all expected to outperform the S&P 500's expected 4.1% earnings growth rate there. And then you see things like energy, materials, consumer staples, and consumer discretionary are some of the lagging sectors in terms of earnings growth this quarter. So, very interesting stuff here. Obviously, this will change over the coming weeks as more companies report their earnings, but good to know heading into earnings season what sectors are expected to outperform in earnings growth. Last but not least, we also got initial claims data for the week ending October 5th. This showed initial claims at 258,000 for this week, marking the highest level in over a year and coming in well above expectations. Some of this increase is likely to have been driven by Hurricane Helene and recent furloughs at Boeing, as there were quite a bit of spikes in North Carolina, Florida, and Washington. Looking ahead, though, some economists are wary that these disruptions, as well as potential impacts from Hurricane Milton, could contribute to a choppy October employment report set to be released just a few days before the November 5th presidential election. So, definitely something we're going to keep our eyes on in the coming weeks. Is it just a few choppy weeks due to weather disruptions and union disputes? Or is it a serious uptrend in the amount of initial claims and higher unemployment due to the overall weaker economy? So something we're going to keep our eye on and continue to monitor. Thank you so much for tuning in to this week's market update, and we look forward to providing another market update to you very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.